Something unprecedented just happened in the global silver market, and almost nobody in mainstream finance is explaining it correctly. In the span of less than 1 year, China executed one of the most aggressive reversals in modern commodity history. First, they locked silver down. Then, without warning, they dumped 660 tons into the exact market they were supposedly cutting off. And the most important part is this: it did not work. Silver did not crash. It did not stabilize. It accelerated. To understand why this matters, you need to forget the headlines and focus on the mechanics. Because what Beijing just revealed was not strength. It was desperation. At the beginning of last year, China quietly placed silver under state trading export controls. No dramatic press conference. No loud announcements. Just a policy notice buried in bureaucratic language. But the message was unmistakable. From that moment on, silver leaving China would require government approval, the same system used for rare earth elements and other strategic materials. Markets understood exactly what that meant. China was signaling that silver was no longer just another industrial input. It was now a strategic resource. Analysts immediately predicted shortages. Manufacturers began securing forward supply. Physical premiums started creeping higher. Silver prices began climbing, not explosively at first, but steadily, methodically, like a pressure gauge rising with no release valve in sight. The logic seemed straightforward. China produces a large share of global silver, consumes even more, and dominates solar manufacturing, electronics, and advanced industrial fabrication. Locking down silver made sense. If the goal was to protect domestic supply and force the rest of the world to compete for what remained. And for several months, that narrative held. Until October. That is when China did something that shattered the entire framework. They exported 660 tons of silver in a single month. Not gradually, not cautiously, all at once, and not to just anywhere, but directly into the London market, the very pricing hub Beijing was supposedly trying to insulate itself from. This was not a policy adjustment. This was an emergency release. To put that volume in perspective, China's typical monthly silver exports over the prior 5 years averaged less than half that amount. This was more than double normal levels, released in a market already strained by tight inventories and surging industrial demand. If the goal was to crush prices, it failed completely. Instead of falling, silver surged to new all-time highs within weeks. That single fact tells you everything you need to know about the true condition of the market. You cannot dump supply into a market that is structurally broken and expect it to behave normally. You cannot fix a multi-year deficit with a one-time release, no matter how large. And you cannot stabilize a system when the underlying math is working against you. To understand why China reversed course so violently, you have to look at what was happening inside its own borders while the world was focused on London. For years, China had been drawing down silver inventories quietly. The Shanghai Futures Exchange, which tracks visible domestic stockpiles, tells a story that should alarm anyone paying attention. Over the past several years, those inventories collapsed by roughly 3/4. What was once a comfortable buffer turned into a razor-thin margin. This was not the result of speculation. It was consumption. China's solar industry alone consumes enormous amounts of silver. Every panel requires silver paste for electrical contacts. As installation rates surged to record levels, silver usage followed. Add electric vehicles, consumer electronics, industrial automation, and defense applications, and the demand curve becomes relentless. By the time export restrictions were announced, China was not hoarding silver to gain leverage. They were restricting exports because they were already running short. That is the first illusion that just collapsed. The second illusion was that China still controlled the market. By early autumn, the London silver market began experiencing what traders call a physical squeeze. Inventory available for immediate delivery tightened dramatically. Buyers were willing to pay escalating premiums just to secure metal. Delivery times stretched. Arbitrage signals began flashing red. This is where the real pressure point emerged. Shanghai silver had already been trading at a significant premium over Western prices earlier in the year, even after accounting for import taxes. That meant Chinese traders were incentivized to bring silver into the country, not ship it out. But when London premiums exploded even higher, the flow reversed out of necessity. China was forced into a role it did not want. Supplier of last resort. The October export was not about strategy. It was about preventing the global pricing mechanism from breaking. If London had seized up completely, price discovery would have collapsed. Contracts would have failed, and the ripple effects would have spread through manufacturing, finance, and trade. Beijing chose the lesser of two evils. They sacrificed their remaining stockpile to keep the system alive, and the market barely noticed. Within weeks of the October release, silver pushed through levels that had previously acted as psychological ceilings. Instead of calming traders, the dump confirmed their worst fears. If 660 tons could not suppress prices, then supply was far tighter than anyone had publicly admitted. This is where the narrative flips from surprising to dangerous. Because while China was exporting silver to stabilize London, another force was pulling metal out of the system even faster. India. In just a matter of weeks, India imported volumes of silver that stunned commodity analysts. Thousands of tons flowed in over a short window, feeding both industrial demand and a population that prefers holding physical metal over weakening currency. And the roading matters. A significant portion of that silver passed through financial hubs, traditionally used for Chinese metal moving into Western markets. The implication is clear. Silver was moving in loops, not lines. China to London, London to India. Warehouses draining on both ends. This was not normal trade. This was emergency redistribution. And yet, even with this massive relocation, premiums remained elevated everywhere. Shanghai prices stayed well above Western benchmarks. Indian futures reflected acute scarcity. Physical buyers faced delays measured in weeks, not days. These are not the symptoms of a speculative bubble. They are the symptoms of a system that cannot source enough material to meet real world demand. The reason this matters goes far beyond price charts. Silver is not optional. It has the highest electrical conductivity of any metal, the highest thermal conductivity, unique antimicrobial properties. In critical applications, there are no perfect substitutes. Engineers can try to thrift usage, shave margins, or redesign components, but physics does not negotiate. You cannot replace silver paste in solar panels with copper without severe efficiency losses. You cannot downgrade conductors in high-frequency electronics without performance failures. You cannot remove silver from medical environments without increasing infection risk. That is why demand does not disappear when prices rise. It only bends slowly, and at great cost. Now consider the math China is facing. Domestic production covers only a fraction of consumption. The gap is filled by imports and inventory drawdowns. Those inventories have already been depleted at an alarming rate. And the October export proved that even emergency releases barely move the needle. This is the same dynamic that played out in other strategic materials, with one critical difference. In past cases, there were stockpiles large enough to weaponize. This time, there are not. Visible inventories now represent only a small slice of monthly consumption. Even if off, exchange reserves exist. They are finite, untransparent, and shrinking. Each month of elevated demand deepens the hole. That creates a ticking clock. Because once inventories reach a critical threshold, policy options collapse. Export restrictions hurt domestic industries reliant on global supply chains. Open exports drain what little remains. Either choice forces prices higher. And higher prices do not solve the problem. They simply shift the pain. At some level, prices must rise enough to destroy demand. That is the only mechanism left when supply cannot respond. But destroying demand for silver means slowing solar deployment, delaying infrastructure, constraining electronics production, and stalling energy transitions. That is politically unacceptable, which means the system stays under tension. The October dump did not reset the market. It revealed how close it already was to failure. And the most unsettling part is what happens next. Because when one major player shows weakness, everyone else adjusts behavior accordingly. Buyers accelerate purchases. Sellers hesitate. Hoarding increases. Liquidity vanishes. This is how shortages become self-reinforcing. Every indicator to watch is flashing warning signs. Inventory reports, physical premiums, delivery timelines, cross-market spreads. They all tell the same story. Silver is no longer just trading. It is being rationed. Once a market enters that phase, the endgame is not subtle. It is abrupt, unforgiving, and impossible to smooth out with clever policy language or temporary interventions. There are only two paths forward once structural stress reaches this level. Either new supply appears, which takes years of exploration, permitting, financing, and construction, or prices rise until something breaks. And nothing in the current production landscape suggests relief is anywhere close. Global silver mining output has been effectively stagnant for years. New discoveries are rare. Ore grades are declining across major producing regions, meaning miners must move more rock, spend more energy, and invest more capital just to extract the same amount of metal. At the same time, capital investment has lagged badly because silver prices were artificially restrained for too long. When prices do not justify risk, capital does not flow. Projects are delayed. Exploration budgets are cut. Mines age without replacement. That is not a temporary problem. That is a structural one, and it cannot be reversed quickly. You cannot flip a switch and create silver. Even if prices doubled overnight, it would not suddenly bring new supply to market. It would take years before higher prices translate into additional output. By then, the deficit would be even larger, inventories even thinner, and demand even more entrenched. That time lag is what turns shortages into crises. This is why geopolitical risk now sits directly on top of an already unstable structure. When governments formally label materials as critical, they are not doing it for academic reasons. They are preparing legal and political frameworks for intervention. That can mean tariffs. It can mean export controls. It can mean strategic stockpiling or forced domestic allocation. Every one of those actions distorts trade flows and amplifies scarcity elsewhere. Once that process begins, markets stop behaving like markets. Paper silver begins to lose credibility because it is only valuable if it can be converted into physical metal. Futures contracts exist on the assumption that delivery is possible. When delivery becomes uncertain, the entire structure wobbles. Cash settlement becomes more common. Force majeure clauses are discussed. Trust erodes quietly at first, then all at once. This is not theoretical. It has happened before in other commodities, and the pattern is always the same. At first, officials insist everything is under control. Then they reassure markets that supply chains are resilient. Then they quietly change rules behind the scenes. And finally, prices gap higher in a way that shocks even seasoned participants. When silver moves in that environment, it does not move slowly. It does not respect trend lines or analyst targets. It gaps. It overshoots. It ignores conventional valuation metrics because valuation no longer matters. Availability matters. Fundamentals do not disappear during these moves. They are the reason the move happens, but once it starts, price races ahead of them. The October event was supposed to restore confidence. That was the intent. Flood the market with supply. Prove that there is plenty of metal. Show traders that any rally will be met with force. Instead, it confirms scarcity. China showed the world that even a massive emergency release could not stop the market. That single act revealed something far more important than the volume itself. It revealed limits. It showed that China cannot both feed its domestic industrial engine and stabilize global markets indefinitely. Those two objectives are incompatible when supply is constrained and demand is non-negotiable. Something has to give. And the longer that tension remains unresolved, the more violent the resolution becomes. Markets do not gradually adjust to that kind of imbalance. They tolerate it until they cannot, and then they reprice suddenly. This is why institutional players reposition early. They do not wait for headlines. They do not wait for confirmation from mainstream narratives. They watch inventory data, delivery times, and cross-market spreads. When those indicators flash red, they move quietly, securing physical supply, rolling contracts forward, and accepting premiums as the cost of certainty. This is why physical buyers accept premiums that would have seemed absurd just a few years ago. When availability is uncertain, price becomes secondary. Delivery becomes the asset. Owning metal in hand matters more than owning a promise on paper. The math behind all of this is not complicated, which is why it is so dangerous. Consumption exceeds production. Inventories are shrinking. Demand is largely inelastic because silver is essential, not optional. Substitutes are inadequate or non-existent for critical applications. Policy tools have already been used, and they did not solve the problem. But that combination has only one outcome. Prices rise until behavior changes. That behavior change can take several forms. Industrial users may try to reduce usage at the margins. Some projects may be delayed. Lower priority applications may be abandoned. But none of that happens until prices reach levels that force those decisions. Until then, demand persists, and the pressure builds. This is not driven by hype. It is not driven by narratives or social media enthusiasm. It is driven by physics, chemistry, and arithmetic. Silver conducts electricity better than any other metal. It dissipates heat more efficiently than alternatives. It performs functions that cannot be replicated without compromise. Reality demands it. China's 660-ton release was not a display of control. It was a warning flare. It showed what happens when the world's largest industrial consumer reaches the edge of its available supply and is forced to choose between bad options. It also showed that the rest of the world is more dependent on that metal than many were willing to admit. And limits, once reached, do not negotiate. They do not respond to press releases or policy tweaks. They do not care about intentions. They enforce consequences. The only real question left is not whether the silver market breaks higher. That outcome is already baked into the structure. The question is how suddenly everyone realizes it already has, and how unprepared most participants will be when the shift becomes impossible to ignore.